Banks are collapsing, stocks are selling off, Bitcoin's in free fall, and everybody's panicking. What do you do? Well, don't get mad. Get irked. You've come to the right place. What the heck happened this week? Well, first, on Tuesday and Wednesday, Federal Reserve Chairman Jerome Powell had to testify in front of Congress, where he once again said that he was going to have to raise the interest rates higher and keep them there longer. And for some reason, this was the time the stock market chose to listen to him, even though he's been saying this for months now. So stocks already started to sell off. Wednesday after the close, the crypto bank Silvergate Capital came out and said it was voluntarily shuttering its doors, liquidating its assets, and would cease operations. But that really didn't have a big impact since we already knew it was going to be in trouble one way or the other. The big news came when Silicon Valley Bank came out and said that it was having a crisis. And the way you can tell a bank's having a crisis is when the CEO says, "Don't worry, everything's okay." From Wednesday's close, where Silicon Valley Bank was valued at $267. It got zeroed out on Friday when the FDIC came in and took over the bank, which is what it does when a bank is struggling. So what exactly happened to SVB? Let me try to explain it to you in a quick way. The majority of the bank's clients were startup companies, and SVB would give these startup companies loans based on the shares of the companies. These haven't come public yet, so SVB had to value the shares and then give a loan to the company based on that value assessment. And Silicon Valley Bank's been doing this for 40 years. It had a really reliable model. It survived through the great financial crisis. But here's where things got a little wonky. After everything kind of collapsed in 2022, the IPO market, the market that allows a startup company to come public, dried up almost entirely. So the majority of these IPOs now had to draw down the bank balances that they had in order to pay payroll and continue operations. Well, back at the beginning of 2022, SVB had billions of dollars on its balance sheet. And unlike you and me, we would just keep that money in a bank account. Because it's a bank, it has to earn some sort of return on it. SVB bought 3-year treasuries. They bought billions of dollars worth. And this is actually a conservative investment. You're lending the United States government money, and in return, they're paying you interest. And at the end of 3 years, you get to have your original capital back plus the interest that you earned. However, if you need to sell those treasuries anywhere before the 3-year maturity, it all depends on the interest rate. If the interest rate has gone higher, you'll have to sell your bonds at a lower price to offset that interest rate. If the interest rates go lower, you can actually make money selling your bonds because you're now going to get a higher interest rate than you would before if you bought those bonds. Well, as you remember, the Federal Reserve raised interest rates from about 0 to over 5% over the course of the last year. So when Silicon Valley Bank had to sell those billions of dollars worth of treasuries, they had to do so at an epic loss. As a result, Silicon Valley Bank had to take on billions of dollars in losses and ended up spinning out of control. On Thursday night, they announced that they were trying to sell the bank, but nobody wanted to buy it. And this is when the FDIC comes in. The FDIC comes in like an FBI raid. They take control of all of your bank's assets, and no one who works at the bank gets to have any hands-on from that point forward. FDIC's job is to try and see if they can make it so that your assets will survive, not the bank. You've probably heard the term too big to fail when it's describing banks, but that's referring to the major money center banks. Think JP Morgan, Citibank, Wells Fargo, Bank of America. This does not refer to the regional banks, which is what Silicon Valley Bank was. So when it collapsed on Friday, there was a rush to sell all of the regional banks because at this point, no one really knows what they're doing when it comes to what kind of investments these banks are in. In fact, that spread to the major money center banks, and poof, there you go. You have an instant market-wide sell-off. So Thursday and Friday saw a huge sell-off. To make matters even worse, the job report that came out on Friday was hotter than expected. The economy had created more jobs in February than everybody thought. It made more than 300,000 jobs, and the estimates were around 225,000. So at this very moment on Saturday, when this video goes up, the FDIC is right now looking through Silicon Valley Bank's assets, and they're reaching out to the major money center banks to see if they'll buy those loans, even if it's bad debt. Hopefully, the FDIC will be able to make it so that anyone who held money at the bank that wasn't insured, which means they had more than $250,000 in their accounts, will be made whole because of this asset reallocation. However, we don't know how long that's going to be, and a lot of companies, including publicly traded ones like Roku, have come out and announced that they did have money at the bank. In fact, Roku had over $400 million with SVB. Although it's likely that Roku will get its money back and that everybody will be made whole, there is the possibility that FDIC can't find people to buy these assets, at which point we do have a bit more of a systemic problem. I've been in the market since 1998, and I remember the great financial crisis in 2007 and 2008. When Bear Stearns and Lehman Brothers went under, everybody thought that was the end of it. But it turned out they were interlinked with all the other banks, and the Federal Reserve had to step in and stop the monetary system from collapsing entirely. Now, could that happen here? Not really. The chances are very slim. But I'm an investor. I'm already long. There's no point in me being bullish. I need to worry about the downside, the bearish argument. There's no reason for me to be optimistic as a long-term investor. I already am. I'm long all of these stocks. So if the market goes up, I make a profit. There's no point in me worrying about that. Because of this, I always worry about the worst case scenario. And it's possible this could be systemic. You might be asking yourself how. Well, we don't know all the different publicly traded companies that might have had bank accounts there. And with major companies like Block and PayPal and a whole bunch of other fintechs that are extremely interlinked with the main banking system, if they held a lot of assets with Silicon Valley Bank and lost them, this could be catastrophic. Combine that with a whole bunch of reports that'll be coming out next week, like CPI, PPI, retail sales, and we've got a very exciting week ahead of us. So from here, it's always my same discipline. Make a plan for what you're going to do if stocks go up next week, and make a plan for what you're going to do if they go down. You know it's a bad week when the biggest winner in a portfolio is just the one that lost the least. And in this case, it's Apple, which only lost 1.66% this week, and that makes it the winner. This week's loser is Schwab, and it dropped 24.18% this week on rumors that it might be having financial difficulties. On Thursday, JP Morgan reported that Schwab had a large block sale. What that means is a single large shareholder wants to sell a huge amount of stock all at the same time, and this made people worry about Schwab. In fact, since I keep several of my portfolios at Schwab, I actually liquidated the money market funds that I held. The reason for this is that your cash and stocks are always SIPC insured when you're at a brokerage, but money market funds are not. And even though this means I'm not earning 4% on that cash anymore, I feel like it's better to be conservative. I need to manage my risk. So I need to make sure I'm not going to lose that cash hoard in case Schwab does go under. To be clear, I don't think Schwab's going under. I think it's fine. But there's no point in me taking that risk because I can always buy back into those money funds in a week or two when everything settles out. Over in speculation and play, this week's winner is the ProShares UltraPro Short SPY fund, SPXU, which is inversely correlated to the S&P 500. So when the S&P 500 goes down, the SPXU goes up, and it did so to the tune of 14.83%. This week's loser is obviously Silvergate Capital, and I'll go more into detail with that later, but it dropped 56.15% this week alone. Taking a look at the market cap of my investments in play portfolio, you'll see that not much has changed this week. Nvidia and Apple are still the number 1 and 2 positions. However, the new spec basket, which holds a bunch of new volatile stocks, has actually dropped from 5th place all the way into 7th place, with the old spec basket taking its place as 6th place. What this means to me is that the speculative money is being pulled out of these newcomers that are high flyers and extremely volatile, and instead being put into more reliable companies that have been around for a while. And that's what you'd expect when you see a market-wide sell-off like we saw this week. I added to Canopy Growth Corporation twice this week. The first on March 7th at $2.21, where it had been testing a point of support. That support failed to hold, so my next buy was on March 10th at $2.09, which had previously been Canopy's all-time low. And like I say, you can never trust a bottom, because Canopy Growth ended up breaking through that low. Its new low is down here at $2.02, and there's no reason to expect that one to hold either. And if Canopy breaks through the $2 mark, we'll probably see an even more epic sell-off, because a lot of people use that psychological round number as a way to sell out. My combined buys gave me an average price of $2.20. and lowered my per share cost 16.67%. From $5.40 to $4.50. My next buy will be my last buy, and it's at $1.09. The way I calculated this was using Fibonacci method. If you draw from the low of this move to the high of this move and scroll out, you can see that the next place that it has support before $1 even is around $1.10, which is why I picked $1.09 as my next buy. Like I say, I don't typically buy a stock below $1, and I have no intent to do so with Canopy. So the way I protect against Canopy potentially going bankrupt is I know exactly the amount that I'm willing to risk. And yes, just like Silicon Valley Bank, Canopy Growth could go bankrupt in a hurry, so I'm prepared to lose every dollar I have in this investment entirely. From here, my next sell target is $4.75, just under its high from 2022 when it ran up into what they thought was going to be the safe banking bill passage at the end of December. And that's where I'll pull a lot of money back out of this position if it gets that high. I closed my position in Las Vegas Sands this week at $55.13. And the way I did it was using a stop loss limit order. Now I say that I only sell on green days, but in this particular case, I had so much profit in LVS that I didn't want to risk having it sell off. So I set a stop loss just under the low of this day so that if it broke through that point of support, that it would automatically sell my position at a key limit order. That means it wouldn't sell less than what I wanted, but it could sell for more than what I wanted. And it did so at $55.13 back on March 10th. This gave my position, which I opened in August of 2021, an entire lifetime gain of 56.55%. Annualized, that's 37.7% a year, and that's really good when you think about what happened in 2022. A few weeks ago, I mentioned that I was not going to short the market using options anymore. Instead, I would use what are called inverse ETFs, and I started doing it this week right before Powell started to speak in front of Congress, because I thought we might see a pullback. I started by buying the Proshares Ultrashort QQQ with the ticker symbol QID. An inverse ETF is one that does the opposite of the underlying asset. In this case, it is the inverse of the NASDAQ ETF, QQQ. However, these are extraordinarily high-risk ETFs because not only is it the inverse, it's also triple leveraged. What that means is if NASDAQ sells off 1%, this ETF will see a gain of around 3%, which is great. However, that also means that if the NASDAQ sells off 1%, this ETF will see a drop of at least 3%, which is not great. Additionally, since it costs a lot of money to manage an ETF like this, and there's a lot of options premium and things involved with fees when it comes to shorting an asset, this will degrade over time anyway. In other words, if NASDAQ never moves and remains flat from here until eternity, QID will continue to lose value because of the amount of money that they have to pay in fees to put the shorts on. The short story of this, pun intended, is that this is a trading vehicle only, not a buy and hold asset. I made my first buy in QID on March 7th at $20.20, and since we've seen the sell-off, you can see that it's gone up in value. My next sell target is up here at $23.25, a point of resistance we've seen in the past. If there is a relief rally in the NASDAQ next week, I will add to this position if it gets down to the low down here at $19.75. And I have additional buys scheduled under that in case we see a significant rally, as I still am bearish going forward. I also opened a position in the ProShares UltraPro Short S&P 500 fund this week, the SPXU. Just like QID, this is a triple leveraged inverse ETF. In this case, the underlying asset is the S&P 500 or the SPY. Just like QID, these are not long-term holds. These are temporary positions that I'm holding because I'm bearish on the markets. And I made my first buy on the 9th at $14.75. And just like QID, you could see that the SPXU has rallied because the S&P 500 sold off. And my next sell target is at $18.45. From here, if we do see a relief rally next week in the S&P 500, I will also add to this position with my next buy at $14.75, a past point of support. I added to my long-term position in Schwab this week because I do have faith the company will survive this, despite the fact that I did liquidate my money market funds with them. When Schwab Schwab saw a significant sell-off on Friday, I added at $59.79. This buy locked in a 27.06% discount on shares that I'd sold for $81.97 back on December 23rd. It also lowered my per share cost 2.6% from $68.58 to $66.85. And from here, my next buy target is $51.07, a past point of support, and my next sell target is $86.58, just under the high from 2023. Finally, the one that I'm sure a lot of my long-term viewers have been waiting for: what happened to the Silvergate Capital position that I opened just last week? Well, like I said in the last week's video, this was a binary trade. Either they were going to report their 10K and that they'd figured out how to survive, or they were going to report that they weren't going to survive. And obviously, they reported that they weren't going to survive. Accordingly, I sold what was left of my position in after-hours trading on Wednesday after the announcement came out. Now, typically, I don't go into after-hours trading. There's too little volume, which makes it extraordinarily volatile. However, we had no idea whether or not the FDIC was going to shut down Silvergate Capital. For some reason, they chose not to, and it did continue trading for the days afterwards. But as you saw with SVB, they did just shut it down outright on Friday. So that could have happened here. I ended up closing my position for $3.25 a share, which means I took a 55.14% loss on this position. And like I said last week, the way I managed risk in this trade was to limit its allocation. It was only 0.7% of the portfolio. So even though I lost 55%, it only dinged the portfolio for 0.49%. And as you can see, the speculation in play portfolio is still up 7.86% year to date. So even though it got dinged, it's doing just fine. To learn more about all my portfolios, check out my website, getirk.com, which is always 100% free. Thank you for watching. Please hit like and subscribe, and I'll see you in the next video.